mode.
Good evening, active traders, and welcome to Trading Momentum and Volatility Breakouts with myself, Ken Calhoun, and my colleague, Vince Vora from www.tradingwins.com. Hey, Vince, it's great to have you with us here tonight.
Great. I'm really happy to be here. It's great to be here with you. Thank you for having me on.
All right, so the way this will work is Vince will do the first half hour, and I'll do the second half hour. I'll just read a quick required disclaimer and then hand it over to Vince. As always, all information is for educational use only. We're not making any advice or recommendations about what to buy, sell, or hold. By watching this, you agree not to make actual trades. We make no profitability or performance claims. It's all for educational use only. So with that, let me turn it over to you, Vince, and look forward to seeing what you're going to say because you're a smart guy. You know what you're talking about, so the traders will get a lot out of this. I remember we did one of these a year ago, and it was really good. So
anyway. We did. Thank you very much. Let me share my screen with you. There you go. You should see my slide that says winning momentum strategy.
Yeah, it looks great.
Excellent. Okay. All right. Well, thanks again. Appreciate it. And thanks to all of you for joining us this evening. I know time is of the essence for all of us, and I really appreciate you coming out. This is our winning momentum strategy. This is a strategy that I've been trading with for many, many years. Like many of the other ones I've put together, this is based solely on technical analysis and is really dependent on trend and momentum. I think with trend and momentum, half the battle's already won if you're trading with that on your side. So let me share that with you this evening. I'm Vince Vora. I am the head trader here at Trading Wins, and I have been doing this for a little over 30 years. It's been quite a ride. We've developed several strategies, and nowadays our strategies and trading systems are used by many retail traders such as yourself, as well as a few hedge funds and money managers as well. I'm going to give you my own disclaimer as well. I always tell everyone, please don't go out and trade with real money until you're completely comfortable with the system you are using. I always have one quick poll question before every presentation, and out of curiosity, how many of you have seen me present at an event or a webinar such as this before? Yes or no, or is it your first time? It'll be interesting to see how many there are. I'm going to take a sip of my water, and then we're going to get right into the presentation. Excellent. Thank you very much. Excuse me, I appreciate that. In today's presentation, I am going to start off with my money management rules, and everything it's fair for me to teach you a strategy and then send you off to use that strategy without actually sharing my money management with you, because this is really the crucial part. This is what protects you throughout your trading career. So I'm going to start there. Then I'm going to talk a bit about the components involved in the strategy. I'm going to bring up my live charts and walk you through it step by step from start to finish, and then hopefully we'll have a couple of minutes for some Q&A. Now, when it comes to money management, there's really 5 simple rules that I live by. The first one you may snark at, you may laugh at. It's not funny at all. This is very, very serious. And what I really mean by this is that when you sit down to trade, you do need a clear mind, and you need to be focused. So turn off the distractions. The chart is the only thing you're going to need. And if you're feeling a little off that day, maybe under the weather, when you're having trouble focusing, that is the time that you make errors. So this business is difficult enough as it is without those challenges. So always try to trade when you have a clear mind and can think clearly. Now, trading is much more important about how you manage a trade once you're in it than it is about selecting an entry. I mean, a lot of traders focus on finding that perfect entry, and although it is important, it's certainly nowhere near as important as how you manage the trade once you're in it. So always try to trade with an amount that feels completely insignificant to you. For some of you, that'll be a couple $100. For others, it'll be several thousand. The amount doesn't matter. What matters is that you're not worried throughout the life of that trade. If you're worried and nervous while you're in that trade, it means you've put too much money in there. So always trade with an amount that feels insignificant. Now, one other step we take to reduce our exposure, our risk in the markets, is to make sure we never put more than 5% in any one trade. And this is really for those of you with a smaller account. For those of you with a larger account, you want to even reduce this even further. That way you'll still have a sizable trade on, but you really protect yourself if things go completely wrong. And there's very little we have control over when we're trading, and so we do need to protect ourselves. In a much bigger fashion, we really cannot control those unexpected black swan type events. Best example I can give you is 9/11. That sort of thing we have no control over. So one of the other things I do to protect myself is I make sure I never have more than 50% of my account active in the market at any one time. So if I'm using the 5% rule, that means a maximum of 10 trades at any one time. Now, some of you may be thinking, well, the other half of the account is just sitting there not earning anything. That's not very good. Well, it's meant as a backup plan. I've been doing this for a very long time, and I've seen many people blow their accounts up. This is meant to protect you. If an unexpected event happens and you take a sizable loss, you will have money to put back into the markets and make it back. And with what I'm going to show you today, it really shouldn't take you very long. Now, last but certainly not least, you do need to spread your trades out. There are days when the market can be very strong, either up or down. It really doesn't matter. On a day like when the Dow is up 300 points, the S&P might be up 25, 30 points. You're going to get a lot of setups in the one direction. If you jump in and put on, 8, 9, 10 long trades at a time, and the next day the market retraces on you, you're going to find yourself in a huge hole right off the bat. You do not want to do that. What you want to do is spread your trades out and select the 1 or 2 highest probability trades for whatever time frame you're trading. So spread them out, be very, very selective. A couple other sayings or rules that we follow, and this one is mostly for those of you who may just be starting out. Because we take a very, very small amount of risk with this strategy, as you're going to see in just a moment, you can afford to take small profits as well. Now, as you gain experience as a trader, you will learn how to stick with a trade a little longer each time. But until that happens, get used to banking your profits when you have them, okay? That way you can build your account up, feel a lot more comfortable, gain some confidence, and then you can start focusing on staying in those trades a little longer. Now, if there's one thing that I want you to take away from this session tonight, it's this point number 2 here. You should always remember that trading is never about you or whether you're right or wrong. That matters. You can try to be the best stock picker in the world. No one's going to care, and it's really not going to help your bottom line. What really matters here is how much money you lose when you're right, or when you're wrong, excuse me, and how much money you make when you're right. What I mean is you need to focus on execution. I'm going to give you a plan today. I'm going to give you a strategy, and I gave you my money management plan. If you follow it to a T, it will work for you, but you need to be disciplined enough to follow your plan, okay? So check your ego at the door and just follow the plan as outlined, and that way you won't get into any trouble. Now, this system is based on 3 components. 3 very popular indicators that are quite common among different charting platforms. The first one is the 20-period simple moving average. We've tested this system with exponential, weighted moving averages, different time periods. The 20-period simple moving average based on the close works best, and we use it to help us judge momentum, and I'll explain that in just a moment. Secondly, an indicator that has been extremely popular in Asia for many, many years, and recently, over the last few years, has become popular here at home as well, and that is the Ichimoku Kinko Hyo indicator. We use a very stripped down version to help us immediately identify trend on a chart, and I'll show you how we do that. And lastly, the popular RSI, or Relative Strength Index. Now, this is an indicator normally used to identify overbought and oversold conditions. Once again, we use it differently. This is going to help us pinpoint our entries, and we're going to give you a different setting to use on this as well. So let me bring up my charts and help or walk you through this strategy. Now, before I get to the actual strategy, I'll give you one tip that will make trading much, much easier for you. And that is, if you build a watch list full of stocks that are trending strongly in one direction or the other, you're going to do very, very well right off the bat. In other words, have a look at this chart here of ISRG. If I had to ask you, what the next move is going to be on this chart, it's pretty easy to, or at least to say, hey, the odds are in my favor that this is going to continue moving higher, because it has been for a while. It's very clean, very orderly, very predictable, right? What if I throw up a chart like this? Okay, can you really tell me what the next move is going to be with any degree of certainty here? You're guessing at best here. And even if you have a great strategy, trying to find a buy or sell point in here, okay, they will show up at times, but your odds of getting stopped out are extremely high because of all this back and forth, crazy, volatile action. It's going to be very, very likely that you get stopped out. So if you focus on charts that are nice and clean, and we've seen it on the Dow now for a while, you see it on ISRG, just anything that's nice and clean and orderly, build a watch list like that, and then with the strategy I'll share with you now, you can pinpoint your entries. So let me put on our chart layout here and explain. Normally I go through and add the indicators one at a time and build them up, but in the interest of time, I'm just going to explain what they are. So this blue line here, that's the 20-period simple moving average. And what we do with that is we try to identify momentum. So normally we can look at the price bars or the candlesticks, as I'm using here, and judge the slope. Look at the slope to help us judge momentum. So in periods like this, we can say, yeah, we have upward momentum. Periods that are flat, we really don't have much momentum. Periods downward here, we have some downward momentum, right? So that's pretty easy in itself. Now, what if we have a situation like this where we're moving higher and then suddenly we get a sharp pullback, or what we call a retracement? If we're only using the slope of the price bars, we can make the mistake of thinking that this now is downward momentum, okay? But if you look at the 20-period moving average, while that happens, it maintains its slope higher. First of all, it does a great job of identifying the same degree of slope, or very similar. But throughout this pullback, you'll notice that it really didn't move at all. What this does is help us identify the fact that this is a temporary retracement before a continuation of that trend, okay? So this really does a good job of helping us understand when we have momentum and in what direction. And of course, the more significant the slope, the better. So if you're looking for a long trade, momentum like this is okay, this is better, of course, this is much better. So you want the higher degree of slope possible. Now, how do we judge trend? That's where the stripped down version of the Ichimoku Kinko Hyo indicator comes in. So these shaded areas, this is what we call the cloud. Now, normally with this indicator, there are a lot more lines involved, a lot more moving averages that come along with it. We strip it down and we use only the cloud portion. And the way we read this is, if the price and the moving average are both above the cloud, we consider that an uptrend. If they're both below the cloud, we consider that a downtrend. And if one or both are overlapping the cloud, we consider these areas areas of consolidation, and we do not want to take a trade when that exists, okay? So whenever you bring up a chart in a split second, you should be able to identify whether we have a trend and in what direction it is, and whether we have momentum behind that move. So right now, if we look at the far right, which is where you would normally look when you bring up a chart, we see here that for Disney, we are below the cloud with both price and moving average, right? So we have a downtrend in place. And if we look at the degree of slope on that 20, it's pretty significant. So not only do we have a downtrend, but we have momentum heading in that direction, which is exactly what we're looking for, okay? So when you have those two things, when you know that you do have a clear trend and you have a momentum behind that move that supports the direction of that trend, now we focus our attention to the RSI. And the RSI, you'll notice that it looks different than it normally does. Usually you'll have lines here at the 70 and the 30 level or the 80-20. We've removed those and drawn one right down the middle here at 50. And you'll also notice that we've cut the setting in half. Normally on most charting platforms, this indicator is set to 14. We cut that down to 7. We want a much more responsive RSI. So it's an RSI 7 with a line drawn down the middle. Now, what we're trying to look for here, if we're talking about a short trade, okay, what we're looking for is a downtrend, like we said, being below the cloud. We want downward momentum. And then when we get that retracement, when we start getting that pullback going towards that moving average, as long as the trend, the slope of that moving average is still intact, as long as it doesn't flatten out and roll over, we pay attention to the RSI. And what we're trying to look for is a cross from above that 50 line to below. Now, it could just come back and touch it and bounce off it, but it does have to get back to that 50 level, okay? So getting a 49, for example, here and turning around is not enough. We need to get to 50 or above and then cross back above. Now, if I zoom in here, you'll notice, actually, let me remove these lines here. If you look at my crosshairs, when I hover over the green candle here, you can see that the RSI was still above that 50 line. Now here, today's candle, it's back below. So today's candle, for example, would be what we would call a setup candle. And once we've identified our setup candle, for a short trade, we mark the low here. And what we're waiting for is a trade below that low. If we get a trade below that low, one tick, one penny, whatever it is, below that low, we go short. And whether we buy a put contract or we sell short the stock, any way you want to do it, we go short. Our stop will go just above the most recent pivot high, in this case back in here. So we give ourselves a bit of a buffer. Now, you notice how it's crossed back and forth a couple times here. I'm going to get back to that in just a moment. This is actually a very powerful setup, but I'll explain it in just a moment. So here you have Disney that's setting up today for a short. So tomorrow, if we get a trade below the low, we're good to short this. So here's one to keep on your list for tomorrow. But let me go back and explain the long setup, and then we'll give you a few more examples here. So the long setup is just the opposite. In other words, we're looking for price and the moving average to be above the cloud, and we're looking for a significant slope upward in that moving average. When we have those two, we're looking for some kind of retracement, okay, some kind of pullback towards the moving average, like we see here, okay. And once it starts pulling back, we turn our attention to the RSI, and we wait for it to come back to that 50 line or just below, and then cross back above. Once we identify the candle that that is associated with that cross, that would be our setup candle. Okay, we mark the high of that candle, and if we get a trade above it, we go long. And if it pulls back on us, once we go long, that is, our stop is right here below the most recent pivot. Now, if we don't get a cross above that high in the next two candles, we don't normally take that trade. Same with the short here. So if it doesn't happen within the next two candles, we ignore it. Simply because if it doesn't happen right away, then maybe the momentum isn't as strong as we initially thought, right? So in a nutshell, that is the strategy. And as simple as it may seem, it is extremely effective. Now, there are a couple other things to look at. One is when you get across from one side of the cloud to the other of that moving average with a slope already intact, that's a major heads up that there is a big move coming in that direction. So you see here the slope we had from before we crossed to after, major move. Look at the slope here coming through the cloud. And again, we get another major move. Again, we get it here and we get a major move. It's not 100%. It doesn't happen all the time, but it is extremely accurate. Okay. Look at, let's go back and look at crude. You remember when crude was trading at over $100? If my chart will refresh, there it is. Look at the heads up that a big move was coming. There's that cross through that cloud with slope. Now, at the time, if you had asked me, I would have never thought it would go to 40, let alone 26. But this called the major move. So once you see that, you add it to your watch list and you just wait for pullbacks. Now, in this case, there wasn't any pullback throughout here. There certainly was a real nice short down in here, right here, that move. We caught all of that. But if you build a watch list of stock that are, nice clean charts that are trending nicely, and the ones that are just crossing from one side to the other with slope, then you just sit back and you wait for those pullbacks and you start taking those trades. It's extremely, extremely effective. And the time frame or the market doesn't matter. You see, this is a weekly time frame. We can look at let's look at 3M. I want to look at 3M because 3M has another setup like Disney. So you can walk away with another setup right here. So here's that cross through the cloud with slope and a major move happens, right? Throughout that, there were setups like back in here. Real nice setup. It pulls back, it crosses here. We still have slope in that moving average, and you get a nice move, okay? What happen here when the average is either 5 or point lower, you don't want to take them, regardless of whether they work out or not. You want the high percentage plays, okay? Right now, we just got another cross from one side to the other, and this is our first pullback. Now, this hasn't happened just yet. We haven't crossed back above yet, but it could happen as early as tomorrow. So this is one you want to keep on your watch list. If that cross happens tomorrow, then you mark the high candle, and if you get a trade through it the next day, then you're off and running. Now, again, this doesn't have to be on the daily time frame. It could be any time frame, and you can trade anything. Let's look, for example, let's go down to, I don't know, the 1 minute chart and see if there's anything here. Cross cloud, nice trend, nice momentum in place. You get an orderly pullback. You get the RSI, and here's that multiple cross thing that I was talking about. We call double dip, very important. You see how it came down to that 50, it crossed above. This is the candle here. When we went high of it, we never did get a trade within the next two candles above it. Then it crossed back below, and then it crossed again. That is a very, very powerful setup. Normally, you get big moves off it, and there it was. Okay. So whether you're on a 1 minute, a 5 minute, whether you're trading pair, it really doesn't matter. Okay. Let's look at the USD CAD pair recently. We come through the cloud with strong momentum, right? We kind of go sideways, pull up a little here, enough to get that RSI line to the 50, and then it turns over. And look at that monster move. Why? Because of momentum. Look how much momentum we had behind that. Okay? It's very easy to spot when you get used to this, and it is extremely effective. Okay, you know, look at today. I'm not sure how many of you paid attention to the IPO for Roku. That's the new streaming service. Came out, opened at 1578, went down 3 cents to 1575, and then just took off and exploded. Closed at 2350. Now, I don't normally touch IPOs, and we're not going to really make use of a daily chart here over the next 4 to 6 months. We need some data, right? But once it opened, if you turn your chart to the 1 minute chart, there were some real nice setups. Have a look. We cross through that cloud, right? We go kind of silent. We get the RSI back to 50. It crosses, and boom, there's that explosion, right? Later, we cross to the downside. Now we're looking for short trades, right? We get that cross back here. We get a cross of the RSI, and boom, there's that short. Then we cross here. That means a big move coming in that direction. The big move didn't happen right away, kind of went quiet for a while, but then we started sloping higher on that moving average. And there's a double dip right here. There's that cross, and off it went, okay? Now you're gonna get a lot of setups here with this. So the thought behind this is not to take every single setup, but to be selective and pick the best of the best. One of the ways we teach you to do that is we've put together a pro course on this, what we call a zero to mastery on this. And if you go to tradingwins.com/setup, that'll take you to this page where it'll explain everything that comes with this on-demand recording. During this recording, I teach you everything from entry to exit in much more detail. We take a lot more time with it. And I actually share with you 6 different exit strategies, but we'll focus on the one that I've been using most often, that I find most consistent. And the reason I teach you 6 is every trader has a different style, and so I want you to feel comfortable with this, but I will tell you the one that I use most. Then, to make this even more accurate, I'll teach you a very unique way of identifying the most significant areas of support and resistance on any chart. But I will also teach you 2 Fibonacci tools, one that will help you confirm your entries and the other that will help you set targets. But it's the combination of these 2 together that really, really improve this strategy and also really help you make that selection. So on any given at any given time, if you have 5 different trade setups and you want to choose the best of the best, these are the tools that will help you do that. Again, it works on stocks, options, futures, forex, any time frame, really doesn't matter. Now, as a bonus, we're going to throw in our Ichimoku Kinko Hyo course. We teach a totally separate course on this. We sell it for $197 on our site. We're going to throw it in. That way you actually have 2 strategies, because this indicator is normally used as a strategy in itself, and I'll teach you how to recognize that and how to use that. And then to make sure we're not just sending you off on your own, but to make sure we're supporting you, we're going to throw in a 30-day membership to our pro service. And I'll just take a moment to tell you what that entails. Every week from Sunday to Thursday evening, 5 times a week, I'll send you nightly videos where I recap what happened in the markets that day, where I think things are going. And that is also the platform where I share my trade ideas. I'll tell you what I'm doing so you can look over my shoulder and learn from that. And we also get together twice a week with our members. We have live market chats every Monday evening and every Thursday morning. You get to come into our room, ask me any trading related question you want, not just on the system, but anything. I'm there to help you. They're all recorded, and all the recordings will be put in your own personal video library. And also for our pro members, every month we do a course of the month free of charge for them. That's also recorded and put in your personal library. The next course of the month actually happens this coming Tuesday. All right, this coming Tuesday, October 3rd, I believe it is, where we're doing our next course of the month. So all in all, you're going to get this course along with the Ichimoku course, along with everything that's included for the next 30 days in our membership program, which includes the nightly videos, the twice weekly live market chats, and you're also going to get the course of the month, all for just $47. Again, the link is tradingwins.com/setup. And I believe I am out of time, so I will ask Ken to come back in. Ken, again, I really appreciate you having me on this evening. Really enjoyed it, and hopefully we can do it again soon. If anyone has any questions on this at all, you can email me at info@tradingwins.com. Thank you very much.
Well, thank you very much, Vince Vora. Outstanding strategy that you outlined there. You did a really intelligent job of identifying not only Ichimoku clouds, but that was an interesting variant on how to use the RSI very intelligently. So I like your focus on strong charts and sensible signals that make sense. And you certainly put together a great offer for all of our traders. So I do recommend Vince Vora. He's one of the good guys. He knows what he's talking about. So Vince, thanks so much for being here. I appreciate it.
Thanks again, Ken. Appreciate it. Take care, everyone.
All right, well, that was a good presentation. I like working with smart people. It's refreshing. We're going to look at some outstanding charts tonight. I'm Ken Calhoun from Trade Mastery and the original Day Trading University. I completely agree with Vince that you need to focus on well-mannered, orderly charts and looking at very strong charts, whether you're trading cheap instruments, which I don't favor much, but if you do, make sure they've got a reasonably strong uptrend continuation. My current favorite chart is this one, DAN, and it runs all the way from 24 to 28. And if you look at this is on a 15-day, 15-minute candlestick chart. If you look at the daily chart, we've got plenty of breakout patterns to look at, both continuous uptrends as well as others. So we're going to look at some ins and outs of how to trade those in tonight's event. And take note. I was taking notes to what Vince was saying. He's a smart guy. I like learning from people that know what they're talking about. It's great. So anyways, highly recommend Vince Vora over at tradingwins.com. You may have seen me since 1999 all over the place. I'm a busy guy. I've been publishing for years every single month in stocks and commodities with my Trading on Momentum column. I'm even on page 7 this month in the front of the magazine. So that's kind of neat. I like showing that to my daughter as a good role model. She's going to college. So I've been featured in CBS Market Watch since when dinosaurs roamed the earth back in 2001. So anyway, it's great to see all of you here tonight. And this is kind of it for my PowerPoint slides. I want to show you the strongest day in swing trading charts with minor gap continuations, how to trade multi-day high breakouts, and entries following wide candle days. So with that, let's go ahead and jump into the chart, shall we? One of the things that I have found in trading as much as $4.9 million worth of real money trades in a single year is that, as Vince said, as all of us who know what we're talking about will tell you, strong charts right out of the gate make your job as a trader that much easier. Because at the end of the day, you and I both know that it's all about risk management. Kind of like when it comes to losing weight. If you ever struggle with losing weight, the 4 words that work are eat less, move more. Kind of that's it. There's no rocket science behind it. To trade successfully, it's very much about tight stops, strong charts. Okay, and I completely agree with Vince's point about you trade with amounts that are insubstantial to you. What I call that is trade wide, not deep. And you may have seen my appearances on TV and whatnot talking about that, where you're diversifying by trading a number of different instruments. My hope in tonight's event is that you learn the kinds of charts that are worth trading and some specific nuances of how to make those work. If you want a quick example of a technical indicator driven play that I'm an advocate of, that I've taught for many years whenever I speak at Money Show and the rest of it, it's the ADX over 40 strategy. And in this, we're simply looking for the ADX red line to break over 40. That generates a signal day. Odds are you and I don't see it on that day. What I do is I'll set a buy stop limit order for 50 cents or so above the high of that signal day. So whenever the ADX comes from below and then pierces 40, and I intentionally, any of us who've been around the block a few times know you don't use the indicators right out of the box. You tweak them a little bit. Now I still use a 14-step parameter on the Wilder's average directional index, but I like intentionally decoloring the DMI plus and minus line, so we just have a red signal line. When the ADX comes from below, this is a rider downer. I've tested this out with hundreds of trades over the last years, and it's a very effective Simple to spot strategy. Go through your charts and look for ones in which the ADX is from under 40, breaks above 40 in a pre-existing uptrending chart. And then odds are you don't see it that day. You put 50 cents as a trigger above that breakout high, which in this case would have got us in at 670 right here on the day after, and you're off to the races. So if you're looking for plays in leading indicators, I like the average directional index is one quick one that you can put in your toolbox. Put that in your toolkit. But the main thing I want you to get out of tonight, in addition to that, is the consistent trend approach and how to identify entries and exits using the strongest charts. Now, if we drop down into the daily chart, one of the things that I always am keen to look for are these moving average crossovers. If you're looking for pivots, one of the very strongest patterns you can look for is something that comes from below. Maybe you have a bullish engulfing. It pierces, and I use the 50, the 100, and the 200 SMA because my institutional guys use those, so I like the 20 is also really popular too, so that's a good momentum one as well. But personally, I use the 50, 100, and 200 SMA. Once it pierces that, especially on a high volume day, you'll usually get a continuation move. Now, it's not going to skyrocket out of the gate, usually right out of the start, but what we also look for is a large green candle, and that's what I've highlighted here for you. Large green, something's going on, institutional buyers are coming in on volume. That's a confirmation. All the technical analysts in the world know to jump on this. If you've ever worked with the market makers or specs, the specialists or hedge fund guys, you know that we're always looking for MA crossovers on volume with large green with a signal candle days. So putting together your order flow above that makes sense for breakout. And you can see it didn't even bat an eye at resistance on this cut pattern. It just kept skyrocketing all the way up from 35 to 38. So, and it still has plenty of room to run, most likely. So this is the kind of chart I like to trade because of its underlying technical strength. It's got a really good breakout pattern to work with. And you can see another pattern to memorize. You always want to start off with the Cadillac of charts, maybe the Maserati of charts or McLaren of charts, whatever. Back in the day, Cadillacs were, anyway. You want tight channels and strong continuous uptrends. Another quick, kind of like a poker tell. I won my first poker tournament in Vegas, just a 6-table micro at the Luxor years ago, but it's great being the guy at the end of the session with all the stacks, with all the chips in the stack. One of one of the tells that institutional volume is coming in, and I published on this in Stocks and Commodities magazine, is a stair-step pattern in which there's multiple gaps, meaning 2 or more gaps as part of a tight, focused breakout. So newbie traders would say, well, hey, why should I pay 36 when someone else got in at 35? You know, if we could go back in time, and a lot of traders are resistant to buy high breakouts, and that's completely wrong. The money is on high volume breakouts after minor multiple gap continuations. Some people erroneously say you should buy pullbacks and uptrends. That's hit and miss. Some people say you should never go in the direction of a gap because it'll always fade. Permit me to quote a great line from Pulp Fiction. Allow me to retort. I like minor gap continuations. Or to quote Princess Bride, inconceivable that we would fade gaps unless the gap strength is over 10%. But for minor less than 10% gaps, and I teach this in my howtotradegaps.com downloadable course, a quick sales message there from your handy dandy trader. You like minor gap continuations and strong continuous uptrends. That should be the bread and butter of a good professional trader. One strategy that I teach for years is what I call acceleration ramps, and that's where you've got a steady uptrend followed by, and as Vince said, he's exactly right, these are not really exciting trends. When the slope of the line, if it's way up here like a 80 or 90 degree, that's more likely to do a mean reversion. So we don't want to chase a stock that's in a too sharp of a slope and an uptrend, but anything in the 40 to 70 degree of arc like this, a 45 degree angle breakout uptrend that's accelerating. It started kind of like volume. It's a low volume. We've got a steady uptrend. Then all of a sudden we got a high volume close. That's another strategy. When you have an HVC, a high volume close day, that's the most likely predictor of a breakout on a subsequent day. And yes, you should write that down. And at the end of the day, you need to know patterns that work. One of the patterns that works is high volume closes, just an HVC. You got a high volume, highest volume so far in the entire chart up to this point was on the breakout and that's the point where it exploded from 27 to 29. That brings up another quick technical point for you, and that is thou shalt not buy anything with a 9 in it. You may have seen my recent Stocks and Commodities article. So although I'm an expert and I spent my life for the last 18 years trading breakouts, I never buy anything with a 9 in it because often that will do a false breakout, and avoiding false breakouts is half the battle. So I will buy above whole numbers. In this case, the high volume close, which was here, was over at the 27 whole number. So I will usually go 20 to 50 cents above a whole number to get in on a swing trade, but I will use the 9 as an exit target. So I'm fine buying, say, 22, selling 29, or buying 27, selling 29. I can always rebuy new highs if it's able to take out new highs. Okay, so that's another quick writer down. I've got so many years of experience to compress into a brief presentation. Here's another outstanding chart, DAN. You can see this guy has ran from 24 to 28. One of the most critical determinants of your potential success as a trader is making sure that when you're looking for a chart, you pay attention to the trading range. What kind of range does this guy have? 24 to 28. It's got 4 points of range. That delta, or that differential in range, is absolutely critical. Where traders get into trouble, and I always rag on AT&T, maybe I shouldn't do that, but where traders get in trouble is they take stops that are too big, or they trade the dang choppy charts and try and put, like my colleague Tony Turner called, chart spaghetti on things. Actually, AT&T proved me wrong this time. But oftentimes AT&T's are a horrible chart. Trying to pull up Microsoft here. Okay, that's a horrible chart because it has less than 10% range. That's another rider downer. On a 15-day chart, you want a high-low range of a minimum of 10%. If it fails that test, it's a horrible chart. Just say no. Stop the madness. Don't trade Microsoft. That's an awful chart. Dan, on the other hand, has 24 to 28. It's got a 20%, 4-point range, with a nice, tight, well-mannered, orderly chart that's beautiful. You could have frickin' thrown darts at this all the way on the way up and hopefully made a lot of money with it, right? I always look at charts in terms of the profit potential. If I could get in a TARDIS or a DeLorean or go back in time or whatever and trade this thing, would I have gotten stopped out? And if the answer is no, then it's a good candidate for a future trade in the upper right side of the chart, which is where I dance. That's where I live, in the upper right side of the chart. Simple, strong breakouts that make consistent sense to trade are outstanding. Another pattern to look at, and this is a 90-day daily candlestick chart. There's 2 patterns on this, 2 deltas. 2 patterns to pay attention to. Trying to help you go further and faster. On a bullish cup, if you see a large green candle at the right side of a congestion box or a bullish cup, and I pioneered this approach, other educators have since borrowed it, but that's okay. It's all in the interest of helping people, I suppose. You see a large green signal candle, and one of my articles in Stocks and Commodities mentioned this 3 volume bar increase, a large green signal candle that's significantly like 1.5 or twice as high as the previous average candle height at the right side of prior resistance. That will frequently lead to a nice explosive upside breakout continuation. And it's still in play. We've got a couple of doji up here, so they're not really sure what they want to do. I might hit it at 28.7, but I'm not going to touch it now because we've got uncertain doji here. The point is, the large green signal candle at the right side of a bullish cup did, in fact, with volume confirmation, lead to an upside breakout. The other pattern I want you to note, and this is a rider downer. I'm new to using the annotation tool, so I'm probably overdoing it, but hopefully it makes it clear. Small followed by large green candles, that pairing. It's even better if you have like baby bear, mama bear, papa bear. You got small, medium, large candles. An increase in volatility and momentum. Remember, candles are a visual representation of buying and selling pressure. What's the story of buyers and sellers? If you see a small followed by a large whole row body candle, and it's doing so on increasing volume at new highs, you got a live one. You know, stop the madness. There's got to be a better way. Well, this is a great breakout chart, and that's the type of pattern that you want to be on the lookout for. How to avoid false breakouts. Here's another quick tip. Here's one DVN. It's been on quite the uptrend. And again, here's that large green signal candle piercing, in this case, the 100 simple moving average. And despite a shooting star, it still prevailed and came back to life. It's alive. Pull up your, always make sure you've got a minimum of at least the 200 simple moving average on your charts. I like the 50, 100, and 200. Those are the three I use. But if you are within spitting distance or within shooting range of a 200 SMA, that's an exit target for professional traders. And oftentimes you will see a bearish reversal pattern. Name that candle pattern. Who can tell me what that candle pattern is right under the Western Technical at 38, whole number, which not coincidentally is where the 200 SMA is at. There's all kinds of reasons not to buy this right now is what I'm saying to you. All right, Muir and Chris and Trey, you guys got a bearish engulfing. So you got a bearish engulfment here, which obviously you don't want to go long in here. But even more importantly is if you didn't have this 200 SMA, you might blindly buy a new high at 37.7 and get stopped out. Are you with me so far on this? How many of you have ever bought something that looks like it was a sure thing? It's going up to infinity and beyond. It's a big breakout. I'll buy it up there, derp. And then you get stopped out. And then it runs up to 45 without you. How many of you have ever been directionally correct but lost money on the trade? Boom. You thought it was going to go up. And eventually it did, but not until it stopped you out on the way up. You know, I got good news and bad news. The bad news is I looked up the phrase, it's kind of a little humor here, because that's how I roll. I looked up the phrase millionaire trader in the dictionary, and y'all's picture ain't there. Bada bing. Okay, but that's okay. The good news is you can learn how to trade. I looked up winning trader, and some of your guys' faces weren't in that yearbook, right? But that's all right. We persevere, right? You know, adversity demands action, and part of the action is learning intelligent strategies. So anyway, the point is, if you did not see that 200 overhang here, you might have inadvertently gone long at, say, a new high, say 37.5, 37.80, right? Because that is a sensible breakout trigger. But if you see this that says no, not so fast there, Sparky, because this guy's going to provide a resistance at the whole number that's likely to cause a false breakout. So would I still buy it? That's what I do. I trade for a living. I go and I buy high and I sell higher. So I would go long, but not until we take out a safety buffer, say 38.50, 38.70, somewhere up here. So just as though you don't buy under previous cut pattern highs because of fear that you're going to see some resistance or a shooting star or something at a previous high, you never buy the upper right side of a cup. Okay, and you never buy right under a major institutional moving average. So it's fine it's another strategy. You can look at making your trades work out for buying above 100 simple moving average and selling right below the 200. That's kind of a band trade or banded trade where you're trading within like a highway here, right? And this is starting to cross over here, but trading within the 100 to 200 SMA, that closing that region is fine. But you tighten in a trailing stop or go to cash. That's what I do. You know, like Vince said, a very good classic saying is you don't go broke taking profits. And another thing that Vince said that I really like is you trade amounts that are insignificant next to you. You know, it's like, how to say, I've done as many and a record of real money trades as 304 trades documented in a single morning. That's kind of extreme, and that's my record, so that's kind of too much. But if I'm in 5 or 6 or 8 positions, I don't lose any sleep if 1 or 2 of them go sideways or down. But if I bet the farm on 1 or 2 magic indicators, that's a good way to blow up your trading account. Having done that a couple of times back in the 90s, I know that that's a bad thing. It's kind of funny. I always ask my money show audiences, and I'll ask you folks too, how many of you, show of hands, or nervous laughter is what I get when I speak to these packed standing room only crowds for the Traders Expos, how many of you ever you hide your trading losses from your family or friends? How many of you only talk about your winners, but you don't fess up about your stop losses? Do you know who you are? If that's you, you might want to do something different in your trading, okay? And a big piece of that, and so many educators that I've spoken with and so many of my colleagues, we all share the same common frustration, is that so many of y'all are so dang impatient, you don't want to take time to roll up your sleeves and learn how to do this like a business. You just want alerts. Just say, or can you auto trade for me and just make me rich without me thinking and lifting it? No. And probably that's more a function of the younger kids, like college kids. I just want to make millions of dollars trading penny stocks. Well, let me know how that works out there for you, Sparky. And once you lose all your parents' money, come back and we could talk, because I inherit so many traders from these stupid, false, consistent profits. You can make a fortune trading crap stock. No, just say no. Intelligent people know better. Anyway, back to our charts. So my point is, from a work ethic standpoint, you got to roll up your sleeves. There's no silver bullets. I'd love to get your perspective on this. How many of you agree with me, either type Y or N, that trading, the risk and reward make it such that you do need to buckle down and take time to study before throwing money at the markets, and that there is no magic indicator? The only magic indicator is your profit and loss. Okay, as I've published for years, the math is a lot more important than the chart patterns. Does everyone see this acceleration candle pattern? This is one that I've taught, and I just mentioned it in the earlier chart example. Baby bear, mama bear, papa bear. Or for those of you like going to Starbucks, what do they have, large, venti, grande, or whatnot? I like Americano. I like coffee, hot and black. Anyway, small, medium, large. Okay, that, especially when it's combined with an increase in volume, tells you got a live one. Now, we don't go long, like I said. Thou shalt not buy long right under previous resistance, because that often leads to trouble. But you do go in long, say 50 cents or so above resistance on a breakout when supported with this compression breakout pattern. You got a small, medium, large candle. It's getting hot. The candles are heating up, and now they're on fire, and a little bit of trouble in a pullback, and then eventually it skyrocketed on up, and now we've got our gap continuation. And this is a healthy chart all the way from 36, a base of around 34, 35, all the way up to 40. So we got a nice 4-point run in this guy. And those are the kind of charts that you want to make the bread and butter your trading approach. So again, Halliburton, multi-time frame analysis. My point is, multi-time frame analysis is so important, because if you look at this chart, this is a classic, wonderful, outstanding, beautiful. If I were giving it a grade, it would be an A+ chart. Until, kind of like hiring employees, you want to, or working with colleagues, you want people that are trustworthy and honest. And you want to do a little background check to make sure that there's no skeletons in the closet. If you look at the 90-day chart, it doesn't look so good. We got this big fugly sell-off. You've got the fact that we're right near previous resistance, and you've got the fact that we're right under 200 SMA, so the risk reward is no good up here. So personally, I might day trade it over 46.5, and I'm not going to swing trade this guy until it breaks over 48. And the way that I do this, just so you know, from a practical mechanics of the trade, to roll up your sleeves as a trader, I may have a dozen or 15 buy stop, and I use buy stop limit orders because I don't want to buy this if it gaps to the moon up to 55 or something. But I put like a buy stop 48, limit 48.50 order in the account, and that way maybe it takes a couple weeks before I get the order filled. That's fine. That's how I memorize or remember with the live trade alert the order flows. Use buy stop orders so that the broker does all the heavy lifting. Let's take a look at some treacherous charts. This one will probably get you in trouble. Charts are a lot like people. There's some that are honest and trustworthy and dependable and consistent, like this one, like this one, and this one, or this one, or this one. But there's other charts that are trouble, and they're choppy, and odds are, I don't know if this sounds familiar, let's see, you buy here and you get stopped out. You buy again, you get stopped out. You buy again and you get stopped out. You say, okay, it's going down, I'll go short. Then you get stopped out. Then you go long again, then you get stopped out. And you say, WTF. And you start to pull your hair out and you get frustrated. Hey, it's a minor gap, let me go long. Then I get stopped out. Well, okay, it's taking out new lows, I'll go short. Then I get stopped out, etc. And so the story goes. Charts with too much volatility are stupid and the place where morons trade. Something that ran from 2.5 to 11 is gambling. And yes, I get it that if you bought 1,000 shares here, you'd be up a lot of money up here. But the risk reward numbers are bad, right? If you try and get in, odds are you get stopped out and try and get caught on the razor's edge, or they get caught up and chewed up by the teeth of this. So charts like this, while they may seem all sexy and appealing, it's kind of like a hot woman at a nightclub. Maybe it looks good on the surface, but if you dig into it, you find out there's skeletons in the closet, and it's not such a good idea to settle in with that person. Just speaking from a little personal experience there. So something that looks all glitzy and glamorous is likely to get you and I in trouble. So just say no. Go back to something that you can depend on that's got a steady uptrend. It's so important. Playing with the right charts in the first place makes an epic difference in your trade success rate, right? Or it does for me at least. So remember, minor gap continuations. That's the #1 hallmark of a good trader. It's my favorite #1 play is a minor gap that goes up. And you don't see a lot of chart spaghetti and indicators all over my charts because I use price action and volume and volatility. The first thing that my eye travels to is on, in addition to the trend, but the first thing my eye travels to in a chart is the range. 42 to 48. Could I make money trading that? Sure, it's 6 points on a $40 stock. That beats my 10% rule. So I'd be going in above new highs here. Because this is dangerously close to 49, I'd wait till it breaks 50, right? There's no rush. You know, I may go in at 50.5 or so on a new breakout, but I'm not going to go in early. Whatever you do, don't buy bounces and pullbacks. That's so stupid. So many people, I mean, they'll cherry pick charts, these educators, and say, buy a bounce and a pullback and an uptrend because that's a sure thing. Well, if you go look at a lot of charts, you'll see that it's not so much a sure thing. You buy a bounce, you get stopped out. Another bounce, you get stopped out. Buy another bounce here, and maybe that one works out. So you're 1 for 3. So just play continuous uptrends that make sense. Here's another good explosive breakout. And again, Micron Technologies. If we look at a 2-day chart, this one I'd call the long in my live trading room back here during the breakout run for my traders. And we covered it again for our traders today because it's a nice breakout. But the point is, it's got a nice, clean, continuous move. For intraday trade, this is a 2-day, 1-minute candlestick chart. That's what I use for professional day trading. I'm the sole founder of the original Day Trading University. We also nailed this guy from 1010, was my long call in my live tradingopen.com trading room today for BBRY. I usually don't like these cheap charts because they usually don't run, but this one I made the exception for because the volume was exceptional. And there's a minor gap continuation with a nice bullish cup right under a whole number, right? That's one of my favorite patterns. See, bullish cups, you don't screw around with it under the whole number, but you do go for a trigger above the whole number, and that ran all the way up to the 10.5. So that was a good breakout for our members at tradingopen.com for intraday trading. But this is a good setup chart for that type of a pattern to work out so well, right? So when you look for good breakout charts, whether you're swing or day trading, make sure that you focus on what's most consistent. Now see, what do you notice in common with all these charts? And I know I'm about out of time here, but I just wanted to give you some examples of charts and the thought process of a professional trader as to what makes for a good, likely chart pattern. If you do insist on trading cheap charts, for Pete's sake, make sure they've got consistent trends like this one. Q and ST. I've lost the most money trading the cheapest charts, so I learned the hard way that now I know how, but it took me years to learn that you have to still focus on quality and trading charts that have continuous uptrends, not charts that look all fancy like this HMNY, because that would be treacherous and it'd be really tough. I mean, you know, if you had gotten on a trade there and if you had let it go without being tempted to get in and out, you could have potentially done well. But it's overall a bad odds chart because of the 300% price action range. That's risky business, and we don't want to do that. What we like is more consistent charts. Okay. Here's another good one, SGMS. What you notice about this guy? We went from 36 to 45. It's a 9-point trading range. This was the biggest explosive breakout day, right? The range is all the way from 38.5 up to a close of 42. So quite a few points. It continued to run up, faded back a little, and now it's got a second wind, right? A second breakout leg. So with those two breakout lengths of price action under our belt, we don't go long right here, but I'd wait till somewhere north of 46 to put on a long, but that's a good uptrend continuation chart. The thing that you'll notice about these charts when you compare them with the charts that you've traded is likely you're trading charts that don't have consistency. Even for cheap charts, if you dig far and long enough, you can find charts with good trends like this. This one from 2 up to 3.5, 3.7, WTI. What a chart, what a run. Right, those are the kind you want to focus on. So anyway, these are the types of charts that I like to teach traders how to trade. This, in fact, was one of my swing scans picks of the week. To wrap up, let me give you, just in less than a couple of minutes here, a free offer and a premium offer. If you want to join over 40, what are we up to, 4,500 people? I have to ask my assistant. We're, let's see, TradeMastery.com. I have Saturday Trading Week Ahead events. #1 in the entire industry with verified proof, at least that I've seen. 4,600. I don't know any events that have that many. I've got 4,600 registered as of today for my TradeMastery.com Trading Week Ahead events. They're 20 minutes long. I think that's a big piece of the appeal because it's no BS, no hemming and hawing. I hit the ground running at 10 o'clock for many years now. I started these originally back in the year 2001, but on GoToWebinar the last 5 years. I've been doing these every Saturday for 5 years and built a huge following. You're welcome to join me. And minimal sales pitch is mostly good quality content with a market update, 3 chart picks, a little bit of Q&A, and the very strongest patterns to look for. So if you go to trademastery.com/free, you can join my other 4,600 who have registered for that. And last but not least is swing scans. For the low price of only $7. You can do a 2-week trial in my premium swing picks service. And these are webinars that are half an hour plus Q&A at the end of, right on the tail of the Trading Week Ahead event. So they're 10:30 to 11 every single Saturday. And for that, I've got a video here of me telling you all about the service, so you can watch that. It autoplays. It's only 4 minutes long, so it's pretty quick. You can download a couple of videos here and see what it's all about. So I always like to, I don't know how many of you have ever been disappointed by stuff out there in the trading industry that if you'd only had a preview, you wouldn't have done it. Well, the reason I got so many hundreds of people that have worked with me is, I work really hard to make sure the quality and professionalism is top notch. So put my mouth, money where my mouth is. You could see risk-free. You can just download these without even putting in an email or anything and take a look at what I cover in that. But Swing Scans gives you weekly Saturday events. My top 10 pick. And if you can't make these Saturday webinars, I do record these for my members, and they're in the members area. And you can just log into the members area and get those. Basically, let me show you what you get. I think that's helpful, right? Members area preview. The Swing Scans members area. Basically, what you're getting is this is from last year, but this is just a preview. But each week, every Friday night, I cover these. I update these with 10, actually a total of 14. I have a couple of under 20 and then a couple of ETFs, and then the S&P key support resistance levels. My top 10 picks each week and specific trigger points to practice with are covered. Plus, you can download the video if you can't make it live. So this is a preview from earlier, but anyway, the point is Swing Scans. You can try it for 2 weeks for just $7, so that's a good value. Risk-free. If you don't like it, I'll give you your $7 back. So anyway, I think one of the reasons that it works as a popular service for so many people is I put a lot of work and time into figuring out where the best patterns are and help you learn those. So anyway, that's at swingscans.com. And I'd love to see you there. You can join or try it for $7. The main price is $97 a month, and you can stay as little or as long as you want, but you get a money-back guarantee on the trial. So it's just $7. You can register either PayPal or with regular MasterCard or Visa or whatnot. And it's a trial for 2 weeks for just $7. So anyway, if you want to try Swing Scans, I'd love to see you there. Get started, though. Before you do that, just do my free thing, right? Get to know me. Do my free Saturday Trading Week Ahead. With over 4,620 people registered, there's got to be a little reason why they're so popular. So anyway, you folks have been amazing. Thanks so much for being here. I appreciate the kind words. And it's from Mura, it's a weekly, every single Saturday morning. So, and thanks, Richard. I appreciate that. Richard saying, Ken, thanks for another excellent colleague webinar. Vince gave me lots of great info, and your presentation was outstanding as well. Kudos again. Hey, thanks, Rich. I appreciate it, man. And thanks, everybody, for being here. I appreciate it. I will get the recording to you. Be on the lookout. I'm going to put it on my YouTube channel, but also in addition, because you guys registered, you exclusively will get the WMV high resolution Blu-ray quality downloadable video on my Amazon S3 server, and you'll be sent a private link via GoToWebinar email within 24 hours. So be on the lookout for an email from GoToWebinar that says, webinar replay video here, and you can download the recording of tonight's entire event. So on behalf of Vince Vora over at TradingWinds.com and myself, Ken Calhoun at TradeMastery.com, I wanted to thank you so much for being here. I appreciate your attention, your energy, your commitment to learning. You're to be commended. The people who want to actually make it are the kind of people who are here, because you want to learn the ins and outs of this the right way. So thank you so much for being here. I sincerely appreciate it. Take care and best wishes for success. And until next time, trade with passion, or at least trade with intelligence and caution. Trade lots of instruments. Go wide, not deep. Use real tight stops. Try and make as much money as you can, and let's go get them. Take care and best wishes. Bye-bye.